Hello, everybody. I'm Sasha. I am the CEO and co-founder of Puzzle, and this is my third startup after scaling a couple startups. We wanted to provide something that just gave you the high-level overview of what is accounting and why is it important. So let's just call this Accounting 101 for founders. So we're going to cover the top things you need to know as a founder and why they're important. So to do this, let me introduce our resident expert, Luke Frye.
Thanks, Sasha. Nice to be here, everybody. I'm excited to explain more, but let me tell you a bit why you should listen to what I have to say. I am a Washington State CPA. I was the first accountant at Bench. I had my own tax practice for about 5 years. I was a pilot. So I've seen just about every single way that a startup founder could take care of their accounting and taxes. So with that, I'm going to go ahead and share my screen and let's dive in to Accounting 101 for founders.
Yeah, so we put together this presentation just a little bit to give you the highest level along with some of the top questions that founders ask us. So let's go.
Great. So we're going to talk a bit just high level on what is accounting, why and when is it important, and some top FAQs. This is not going to give you an accounting degree. You're not going to be a professional bookkeeper, but we want to make sure that you have an orientation of where to go, questions to ask, and some vocabulary. So who has to do accounting? I often hear from startup founders that, oh, I don't have a net income or I don't have any revenue, then I don't need to file. But the reality is no matter what, when you have a Delaware C corporation, you need to file taxes every year.
Every year. So the year that you incorporate, starting in that year, everybody, every year, you have to file taxes. You might not have to pay taxes, but you have to file taxes every year.
Yeah, that's a good distinction, Sasha. We often conflate the idea of paying taxes with paying a tax provider. And while it can feel punitive and unpleasant to pay somebody to do your taxes, the reality is most startups never pay tax or not for a very long time if you're venture backed. If you're bootstrapped, that's a bit of a different story because you probably are profitable. So why are we talking about this? Most people have learned, we know what a parallelogram is or some other skills, and certainly, coding and other types of skills with computer science have become more popular. But most people, aside from people like me, don't really learn anything about accounting in school. So hopefully this gives you a bit more of an insight into what it is and why it matters. So accounting can really be a placeholder term for lots of different things, but primarily it's focused on, and what we'll mostly talk about, is the creation of financial statements. This is something that a bookkeeper typically does for you using something like a general ledger, but there are lots of places that we need to use financial statements. One of them is taxes with IRS. If you are in the middle of getting a seed round or Series A, you need it for that fundraising or valuation. You also need it for financial planning and analysis, things like budgeting, scenario planning, trend forecasting, those sorts of things. So accounting is really that basic step that is required for most activities in a business.
And usually this requires two things. It requires a bookkeeper, that's the person doing it, and the software they use to prepare financial statements, which in accounting is called a general ledger. And maybe a good analogy is like to create a good UX design, you want a designer and you need Figma. Like you need both of these things together to hand over a deliverable to your front-end development team.
Yeah, I think that's a good analogy, using Figma and the designer being the bookkeeper. And we often conflate those two. So hopefully we'll give you a bit more insights here. So bookkeeping is that act of taking all of these inputs, whether it's from partners like Mercury, Brex, Ramp, Gusto, Stripe, or many others who have that transactional level detail in order to pull it into one place. That could be where your cash is sitting, hopefully in a treasury account if you have very much right now, spend analysis through things like Ramp or Brex, payroll through Gusto, customer payments through things like Stripe, and bills through places like Ramp.
Right, and as you go to the next slide, one of the important things to keep in mind is these are not your accounting software. These are the inputs to accounting software. So these providers, your bank doesn't provide you the things needed to pay taxes or for fundraising. They're a really important input, which we'll see in the next screen.
Exactly, good distinction. All of those building blocks go into what Sasha mentioned earlier, the general ledger. And of course, we're at Puzzle here, so we're going to talk a little bit about the fact that Puzzle is a general ledger. That's an accounting system. And all of those pieces flow in and are organized in a specific way to then create these outputs. Your three basic financial statements. So if you had Accounting 101 ever, or if you haven't, these are the three basic financial statements. The income statement is where sales and expenses live. The balance sheet is where you see what you owe and what you own, including equity. Cash flow statement is a high-level summary of where cash went. So,
Luke, what is an income statement?
An income statement is really a reflection over a period of time. You notice on this slide we say monthly, so that you might be looking at January sales or 2024 sales on a whole. When in a balance sheet, it's a point in time. So we have cumulative. That means it's a representation of all time. This is really the underpinning, or the results of what we call double entry accounting. So it's one of the beautiful things about financial accounting is that there are it's a closed system with controls. You can't have an in without an out. The other metaphor I use is, like in physics, every action has an equal and opposite reaction. And so that means if something happens on the income statement, there's probably a balance sheet component, and vice versa.
But your income statement is where you would see stuff like your revenue or your gross margin and your total expenses and your EBITDA and your net income at a point, at sort of a period of time, a month, a quarter, a year. A balance sheet would be sort of all the things that you owe, almost like a check register. Like you can look at the cash in your bank account, but that doesn't necessarily give you insight to the things that money people owe you, or money you owe other people, and or maybe assets you've already purchased that you could resell later, like computers or a building or something like that.
Exactly. I'm not sure most of our viewers will remember what a check register is, but I think that is a good example. It's an asset.
Fair point.
It's
I'm an older founder.
The other statement that we want to talk about is the cash flow statement. So it's a high-level summary of cash and inflows and outflows. But Sasha, maybe you can talk more about how we view cash and what we built for founders on our dashboard.
Yeah, I think cash flow statement sounds really exciting, like it's a bucket of where your cash is going. But really, it's kind of a summary of the total cash movement by operations, investing, and financing. It doesn't really give you any insight to what your money movement is. And so we built something called a cash activity report, which is the thing that I always really wanted as a founder, which is like a detailed understanding of all the places money is moving in real time. And so we think it's sort of the next generation of what a cash flow statement is. It's not just, okay, this much money changed hands, but it's how, to the detail, why did it change? How much money did this thing go up or down, whether it's payroll or spend or expenses or marketing. You don't really get a detailed level breakdown. And so we built that first at Puzzle, and that's really fun.
Yeah, and as a CPA, I probably spent the least amount of time of any of these financial statements in the cash flow statement. I don't find it that meaningful in most businesses that would work well with Puzzle at this time. So let's talk a little bit about another idea that often comes up: cash basis and accrual basis. Usually, if you go to a bookkeeper, they're going to make you choose one of these methods. A really nice feature of working with Puzzle is you actually don't have to pick. You get your cash basis financials through the month at any point in time as a draft without having to wait for a month-end close. The month-end close is usually what's involved with creating the accrual basis financials. To elaborate a little bit more, cash basis financials is you recognize revenue when you receive $1, whereas accrual basis financials, you recognize revenue when somebody agrees to pay you something and you've earned it. There are other examples, especially in a software subscription. Say somebody pays you $12,000 today for an annual contract. On a cash basis, you recognize all $12,000 as revenue. On an accrual basis, you actually break that out month by month, which again, it's something that we've automated with Stripe on Puzzle to be able to spread that revenue recognition throughout the whole year.
I have to, this was one of the key insights at Puzzle. And this was because I've scaled my last two companies, and accountants love accrual basis. And the argument is it gives you like a true sense of the health of your business, which does make sense. But this is the reason why accountants aren't able to deliver your financials until like the 20th of even potentially a month or two later, because all of these accrual adjustments need to get completed and done before you can have any insight to your business. But as an operator and as a founder and as an entrepreneur, I want cash basis. Like on the first of the month, I want to see, where did cash move? Did it hit budget? Am I overspending? Did it impact my runway? And I can't get this till later. And so the first thing that we did at Puzzle was we said, you shouldn't have to choose, you should get both. And the benefit to this is, as a founder, I want to see my cash base. I want to see my cash, my burn, my runway, my metrics, where cash flows are moving. Accountants still need to do the accrual basis, but now they can do all of that work. And it doesn't really matter. That's mostly for points of time on financial health and compliance for taxes and for fundraising. And so now you get both of them together. You don't have to choose.
Yeah, really the best of both worlds with Puzzle. So, there are systems out there. I worked at one where you only get cash basis financials, which is great for most small businesses. Throughout the month, even if you're not a very small business, it's still helpful to see where you are on a cash basis. Whereas Sasha mentioned, if you're investors or if you're audited, any of these like higher level, bigger business problems that you hope to have as a startup, you have to have accrual basis. And
once you start doing accrual basis, though, you lose sight of your cash movement. And so it's a big frustration between accounting teams and operating teams, is you have these different views. It's the same underlying data, and that's why we built this data model, but you lose sight of your cash as soon as you commit to accruals. Now, most startups arguably should choose accrual basis, because at some point, if you have hopes of being a larger company, you're going to need to have 3 years of historical accrual financials. And so one argument is you should start doing accruals from day one. The problem is you start losing sight of cash. You start getting delayed insights into your financial statements. It takes a lot more time and it's a lot more expensive. You can also start off in the early days just doing cash. You can still actually file accrual taxes by just making adjustments at the end of the year. And then at some point you can transition to accruals. And so there really isn't any right argument, but investors really want to see accruals. If you're a large business, you have to do accruals. If you're going to stay a small business forever, you can just do cash. Is that right, Luke? Anything to add or change?
Yeah, I think that's a really good point, with the cash giving you a lot more tactical insights. And you're often told that you should have accrual books, but you lose some of that day-to-day tactical insights. And what we're trying to do here at Puzzle is, why pick one? Let's give you both. Let's give you the ability to do both. Awesome. So going to talk a little bit about some of the primary accounting roles. If you've ever worked in like a Fortune 500 company, you probably know there's an entire department of accountants. But the reality is, we've talked a bit about a bookkeeper. They reconcile the accounts and categorize transactions. That's really the groundwork of anything that needs to be done, is reconciling accounts, making sure you have all the transactions, no duplicates, nothing missing, and that they're categorized properly. So categorization refers to putting it into a category or chart of account that either shows up on the balance sheet or the income statement. They might also be doing payroll, AP/AR. An accountant, again, is a bit of a general placeholder term, but typically it's somebody like me who's a CPA. They may have audit experience, and you, as a founder, you probably get told that you need to have GAAP financials. That's something that is code for accruals. Most terms, when they say GAAP financials, they don't really mean you need GAAP financials, because those are very expensive from a CPA firm. What they're really getting at is accruals, or GAAP informed accruals. A controller is literally the person who is in control of the process, as well as any internal controls for avoiding fraud, but also making sure that the financials are in good shape, and accounting policies. So you notice we have a picture of a rear view mirror here. And the reason I put that on this slide is, bookkeepers, accountants, controllers almost always look backwards. These are the people where if they report on the history of what happened, if they're wrong, they usually get fired. Where the CFO is more forward-looking, through the windshield, what's coming up, projecting, forecasting. They are almost never right, but they don't get fired, because it's matching the strategy and working with people to execute on it toward the goals of the company. So when we say accounting and finance, accounting, where I went to college, is in a different school than the finance school. So
yeah, they're different majors, they're different disciplines, they're different skill sets along the way. Now they have to work together
yeah,
to some degree. A bad analogy is like a back-end engineer and a front-end engineer. They're both technically engineers. So there's both technically people that work in financial departments, but they do very different things. It's not a perfect analogy because in this case, your accountants are focused on compliance and alignment, like making sure the data is complete and accurate for compliance and reporting purposes. And a CFO or a financial planning person would do forecasts. So your accountants wouldn't be responsible for what happens if we hire 10 more people, or if we increase marketing, what are the impacts to the business? That would be a finance person or an FP&A person or a financial planning person, an accountant with that. The CFO sits on top to make sure that what you think you're doing matches the reality of what you're doing, meaning your strategy and your reality are aligned. And if they're not, why? And so that's typically how the CFO sort of brings these two departments together.
absolutely. So I talked a bit about this already. Bookkeepers, that ground level, got to do it. This is like taking the trash out, flossing your teeth, brushing your teeth. If you don't do it, there's going to be problems. You can get away without brushing your teeth for a while, but if you do it for a period of time, there will be problems. So those reconciliations, categorization, reviewing them. They might also pay bills, run payroll. They could also do sales tax. Oftentimes, they might do adjustments. They usually don't actually file your taxes. And as Sasha was talking about with the CFO, a bookkeeper typically is not building financial models or even doing budgets or analysis there. So we're coming up to the last few slides here, but we're going to talk more about why is accounting important.
So we sort of put this in the frame of like the top questions we got from founders of like, why do I need to do this? And so the way we're approaching it is, what are the top 5 things that can go right when you do accounting well? And what are the top 5 things that can go wrong to sort of try and bring this into a little bit more reality?
Yeah, I had a founder sign up recently, Sasha, who said that he wanted to start doing his own bookkeeping. They're really managing their burn. In this economy, there are lots of things that are going on, and they wanted to get closer to their business. And they said that they found $500 a month in spending that they got rid of just by doing their own books. So sometimes it's really good to be close to the granular details there. But it also gives you insights on how to improve your business. You probably know more about impressing investors than I do, so maybe you can talk about that.
Yeah, one of the top reasons why investors pass on companies, founders, is they can be in love with the business idea, they can be in love with the model, the market, even the founder. But one of the core responsibilities of being a founder, being the CEO, founder, or running a business is what's called capital allocation, being intentional about where you're spending your money. And so if you can't talk the language of investors, it lowers their confidence that they are going to want to invest in you because they're investors. They're not donators. They want to give you money and have a return on capital. And so being able to speak their language helps give them confidence in fundraising, in board management, and investor updates.
And the other term that you use a lot that I really like is, go from founder to CEO. Like, I founded my own tax firm, and there are lots of other founders out there, but that doesn't mean you have good strategic insights or are really doing everything that you really need to do as an effective CEO. One of the things that happens as a founder is, you may not always be the CEO. And hopefully you build a business big enough that it does outgrow your abilities, unless you're super special. But the reality is, setting up financials and making sure your accounting is in good shape is a basic requirement of a CEO.
Yeah, the sort of concept of capital allocation and resource allocation, like the best founders are the ones that have the motivation and drive of problem solving and are able to be a CEO. And it's also okay to be a founder and say, I don't want to be the CEO, or I don't want to get good at capital allocation, resource allocation, accounting, and finance. That's also totally okay. But somebody needs to be the CEO of a company if you're going to build something profitable, meaningful, and enduring. And so it's just a core part of the responsibility. And so this is what goes well. And the goal is to make it very easy for you to have this as one of your core capabilities, a puzzle. It's the motivating reason why we're working so hard to do this.
Absolutely. All right, let's talk about some reasons.
Dun, dun, dun.
Yeah, Exactly. When stuff doesn't go well. I mentioned the idea of like not flossing or brushing your teeth. And so if you didn't do that for a year and you went to the dentist, eventually there would be some unpleasant consequences. In addition to the shame from the hygienist, you would also probably have some cavities. So the reality is it doesn't seem like accounting is important until it's urgent. And it's really great to just avoid that. Most accountants fill up. It's a fact that there's more accounting work than there are people who can do it. So if you're waiting to the last minute, and last minute in accounting and tax world means months, you need to engage a good tax accountant or bookkeeper months before you actually really need one, in the sense that there will be some time to set up, some time to onboard with them. And that's the nice thing about Puzzle is you can actually do a lot of that yourself or with us on our customer success team, but avoid having to do makeup work. You don't want to be staying up all night, the night before a tax deadline. I had a call like that recently. It's stressful for everybody. You could have massive penalties for non-compliance, especially if you have foreign shareholders or maybe weren't doing payroll right. Sasha, you know more about the last.
I mean, let's assume you don't even care about penalties. You think it's a low risk of getting fired or sued because you control the company. You don't even need a term sheet because you're profitable. Or let's just assume you don't care about penalties, fines, liability, lawsuits. Even just if you don't do this a little bit every day, like brushing your teeth every day, people always, only first-time founders actually, always underestimate how much time it actually takes to get your accounting in order. It's not just like it takes a couple hours or it takes a day or you're up all night. It is days of work, even at the small stage. It is usually weeks or months of work to get in order. And a couple examples from this life is, let's just say you incorporated last April and now you filed an extension the following year. You have to remember 18 months ago, who was at that meal? What was the purpose of that flight? What did you spend this money on? What was the purchase price? Does this thing still exist? You have to know all the details and have the receipts, invoices, documentation, policy findings for all of the money that's moving in the company. It's much easier just to do this when you're spending the money a little at a time because you have the context, you know it. It's the same amount of work. It's actually more work time later. So if it was say an hour a month during the time that you're doing it, it's probably an hour and a half to 2 hours, maybe even 3 or 4 hours worth of work for that same hour later, accumulated by every single day, month that went by. So people always estimate like, I can't believe this takes weeks or months. It is the most common first-time founder mistake.
Yeah, it's sort of like you might remember what you had for breakfast yesterday or today, and you say, okay, I'll remember that next year. But if you extend your tax return, you might be almost 2 years ago trying to remember, why did I fly to Florida? And
yeah, Luke, on April 22nd, 2022, what did you have for breakfast?
Yeah,
like that's the hard thing to remember. It's really easy to remember the day of if you do this. Let's also put this in context of like you're about to get a term sheet or a partner. You're about to close a big partnership deal, and they're like, "Cool, can you just send over the financials? So I want to make sure that you're a good counterparty risk." And now you can't, and it takes you, let's say, 1-2 months to generate any financial statements. You're almost certainly going to lose that deal. You're definitely going to lose that term sheet. It just shows you're not prepared and you're not doing the job of a CEO. Nobody's doing the job of a CEO of a company. It's hard to partner and fund a company that doesn't have a CEO or a CEO title only.
Yeah, and then you get fired or sued, and getting fired from your own company does not sound like fun.
No.
Awesome. When is accounting important? So really from day one, you need to be set up from the get-go. This is a Benjamin Franklin ounce of prevention is worth a pound of cure for sure. Here's some dates to remember. January 31st, 1099s are due. We'll be sharing more content about that. March 1, Delaware franchise tax. April 15th, or if it's a weekend or holiday, it always goes to the next business day. Your income tax is due, same for federal and state. And you can extend those. There's no cost to extend other than perhaps to a preparer. Extensions, I always recommend filing an extension, even if you plan to file on time.
Great.
Awesome.
That's it. Luke, good job. And if you have any questions, we'll do a follow-up session and or just feel free to ask us at puzzle.io.
Absolutely. Thanks, Sasha.